Many people have heard of VA loans, but few truly understand the incredible benefits available through this program. From zero down payment to competitive interest rates, the unique opportunities that many buyers don't even know exist. VA loans can be the most powerful path to homeownership.
Whether you're a veteran actively serving in the military, a military family member, or National Guard, this episode is filled with valuable information.
I'm Isabel Machrone.
And I'm Rosa Ortiz.
We're real estate professionals in Southern California.
And each week we break down what sellers and buyers need to know right now.
This is Let's Talk SoCal Real Estate. We have Ryan.shultz with New American Funding. Hi, Ryan. Can you tell us about yourself, how you got into mortgage, and how long you've been doing this?
Yes. Hello, guys. Good morning. Ryan.shultz. I am with New American Funding. I'm a branch manager and a loan officer. Been in the business 28 years. I've kind of been through the 2007, through all the bad times and the good times, and got into the business fresh out of college, worked in a call center, had to learn by fire, didn't get any training, just pick up a phone and answer questions and see if you could help somebody. So it started that way, and then gradually over the years went from call center to bank to retail, and been at New American about, I think, 11 years now.
Great.
That's impressive.
Today we're focusing on VA loans. And many people know, VA loans are for veterans, but they may not realize that it's also for reservists, National Guard members, and some surviving spouses that may qualify. Can you tell us what exactly is a VA loan and who qualifies?
Of course. Yeah. So VA loans are a great loan. It is a loan created for veterans. It gives them a special program that they can use to get into a property. And yes, not only is it for veterans, but also you could be active duty, you could be a reservist or a National Guard, as long as you had served for 6 years in those capacities. And then for surviving spouses, if they had a spouse that was a veteran and that was disabled or deceased through military action or because of military action, the surviving spouse could be eligible for the VA loan as well.
I didn't know that.
But it has to be a veteran.
No.
Or not.
It does not have to be a veteran. No, it just has to be married or had been married to a veteran that was eligible.
What are the biggest advantages of a VA loan compared to a conventional or an FHA loan?
Okay, great question. VA loans have a few distinct advantages. They are, like I said, they are to help veterans. They're to allow them to get into properties, and it's a little bit easier possibly than a regular loan. So compared to a conventional loan where you need 3 to 5% down, or FHA, you need 3.5% down minimum. On a VA loan, if you have full entitlement, you can buy a property with zero down. So there's zero down payment required. On top of that, normally you're going to have PMI, which is private mortgage insurance. If you're a conventional or FHA buyer and you're putting down less than 20%, you have this additional insurance attached to your payment. For a VA loan, there is no PMI. So basically, you can do zero down, have no monthly mortgage insurance added to your payment, which allows someone to obviously have a lower monthly payment, which is fantastic. That's the goal for everybody. Yeah.
How about the rates? Are they pretty competitive?
The rates are amazing too. You're looking at lower interest rates than a standard loan. So usually about 0.5% lower. I would say conventional rates today are about 6.5, whereas a VA loan, you can be around 5.99. So
okay, that's awesome.
Some big advantages for sure. No down payment, no PMI, and a lower interest rate, which is great.
Beautiful. So many consumers think zero down means no money out of pocket. Can a veteran really purchase a home with no money out of pocket, or what should they
Actually,
expect?
They can. So yeah, if they have full entitlement, they can buy a property with zero down. When you're buying a house, though, obviously you have different things involved. You have closing costs. You have your prepaid items, which is like your impound account for your taxes and your insurance. So if the veteran is going to purchase with zero down, usually you're going to have some additional charges. Now, some of those closing costs are called VA non-allowable fees. So these are fees that the veteran can't pay for. So they either get covered with a credit from the seller or a lender credit. So sometimes we will cover those fees. Now, if there's any remaining fees, then of course the veteran can, if they have some money, they can use their own money to pay that. But a lot of times what you do is ask for a seller credit and give a credit to cover those closing costs. And then if you get enough, at that point, yes, a veteran can come and buy a property with zero out of pocket completely. No closing costs, nothing. So pretty amazing.
Pretty cool. What are those non-allowable fees?
So there's certain fees that are not allowed, like escrow, title, attorney fees. there's a little list of different things that are not allowed to be charged.
Okay.
And so usually when we're putting together that pre-approval or that offer, we'll usually kind of flag how much maybe needs to be a seller credit. Or like I said, a lot of times we do a lender credit to cover that form if they're not getting a seller credit.
Pretty cool.
What type of credit score do they need to have?
Another big advantage for a VA loan. Technically, there's not really a minimum FICO. At New American Funding, our minimum FICO score is 500. So you can go as low as 500 and get a VA loan. You can even have no FICO. So if for some reason they didn't have any credit and they don't have a score that's reporting, we can still do a VA loan for them. So ideally, a lot of times you want to see like a 640 credit score or higher, but you can go lower. And like I said, you can go all the way down to 500 if you have some compensating factors. So a lot of times they might want to see if the credit score is a little bit low, we're going to show why is this a solid loan? And some of the compensating factors could be their debt ratio is low. They have extra money in the bank as like reserves for the monthly payment. Maybe they're putting down some money so they don't have to do zero down. Sometimes people want to put a down payment. So if they're putting like, let's say 5% or more, those are great compensating factors that can offset a low credit score. Don't think just because the credit score is low, you might not be eligible. There's a lot of wiggle room on like VA loans. So it's another big benefit to VA.
Do you find the VA applicants actually wanting to put money down even though they can do zero down?
Sometimes. I mean, majority of the time it's zero down. But yeah, if somebody has a certain monthly payment that they want to get to, they have some money in the bank and they don't want to finance the full amount, then they can definitely put money down. But yeah, majority of the time people want to use the benefit there and just go with the zero down.
I like that. They do get more benefits, which they should.
I love the simplicity of it, that, you're making it easier for the veteran, which is, they deserve it.
They're definitely trying to help veterans get into property. So certain things that are benefits too is like, let's say on a conventional or FHA loan, you have a debt ratio. And let's say the maximum debt ratio for conventional is 50%, which it pretty much is. That means that your monthly house payment plus your bills can't go over 50% of your income. If it does, even by a little bit, the loan will be declined or you'd have to go with a lower purchase price. Again, on a VA loan, there is no set debt ratio. So with compensating factors and things, I've seen debt ratios up in the high 70% where they're approved. So you have this, again, like this flexibility of qualifying probably for a higher purchase price than you would with another type of loan. You're not restricted by that debt ratio or that cap, assuming that everything else looks pretty good.
That's huge.
So yeah, you don't turn down anybody really. You kind of look at the file and go, hey, look, maybe this doesn't look like it would fit normally, but let's see, the whole picture and see if it looks like we could approve you.
Is there loan limits on how much they can purchase or what their purchase power is with the VA loan?
Another benefit. So no, like conventional and FHA definitely have loan limits for the county. There's certain limits that or loan sizes that you can't go over. With a veteran with full entitlement, there is no loan limit. As of right now, I'm just doing a loan for another client. They're buying a property using a VA loan. The property's in Los Angeles. The purchase price is $2.5 million and they are doing zero down.
Wow.
So yeah, normally if you're looking at a $2.5 million property, for most programs, you're looking at 20% down, versus in this case, zero down, which is a gigantic difference.
Can you explain what full entitlement is? What's the difference?
So full entitlement, and this full entitlement is when the veteran has been through, they've been an honorable discharge, they're either out of the military or they're eligible just through the other ways we talked about. They should have full entitlement. And it comes on a form that we have to pull. It's called a certificate of eligibility, and it'll state on the form what their entitlement is. So if they have full entitlement, that's where they can do zero down. If they have partial entitlement or they don't have full entitlement due to having had another VA loan or something like that, then there is a formula that we have to work up and decide how much they need to put down. So if it's not full entitlement, you can't do zero down, but there is and I can't give you an exact number because it depends on case by case, but they can still get a VA loan and get the benefits of no PMI, no loan limit, no debt ratio, things like that, and the lower interest rate. But they may have to put down, let's say 3% or 5%, depending on what the situation is.
Got it. Is that where that's where you find out if they have that VA funding fee? Can you explain that?
Correct. There is something called a VA funding fee, though, that is charged when a person takes a VA loan. So the funding fee is a one-time fee. It's for most standard veterans. The funding fee is 2.1 0.15% of the loan. Okay. So if they're taking a loan, let's say at 100%, they're putting zero down, the actual loan will be marked up, or we'll add that 2.15% onto the loan. So they would usually be financing a little bit more than the loan amount. So the funding fee is built into the loan. They could pay it out of pocket if they choose to. But again, one of the benefits is it gets added to the loan, barely noticeable on the payment because you're just upping that, that loan amount just a little bit. So if they are regular VA, they would have that funding fee of 2.15%. If they're going to put down 5 to 10%, that funding fee drops down to 1.5% of the loan. And if they're putting 10% or more, it drops to 1.25% of the loan. So that is a fee that's added on. And again, it just gets added to the monthly payment. So if you go up a little bit, it may increase your payment $3 a month, but it is part of the transaction.
No one is exempt from it.
Nope, you could be exempt from that. So when we get that certificate of eligibility, again, it's going to show their entitlement. It's going to show the features. And if they're exempt from the funding fee, then there is no funding fee charge. And usually to be exempt, they would have to be received a Purple Heart through the Army. They would have to have been discharged with a disability. It's usually for somebody that was injured, and then they'll waive that funding fee for those individuals.
How does the verification work? Is this something they need to prepare in advance before they meet with you?
You know what? It's actually pretty easy nowadays. So they don't have to have any documents. We could take an application. We can run their information through a site, and it should pull up their certificate of eligibility almost instantly, and then we can go over all the information. If for some reason it can't find it online, then usually the veteran's going to have a DD-214 form. That's their discharge form. And then what we can do is, if for some reason we can't get it online, we can request it and we order it and have it sent to us.
Great. This is all amazing information.
Yes. What a way to get information out to the public, right?
Yeah, I know a lot of, like you said, you've been in the business a long time and you haven't done a lot of VA loans. For some reason, it's not used probably as much as it should. And people maybe don't ask about it, or they're not familiar with it, so they don't go that route. That's one of the questions on the application. One of the first things I ask is, have you ever served in the military? And if they say yes, then light bulb, right? Let's look at some programs that they might be eligible for.
That's fantastic.
Can a veteran have both a VA and another mortgage at the same time?
They can, yeah. So that might be something that people think is you cannot, but you can have a VA loan. A VA loan is primarily it needs to be for a primary residence. So if someone was to buy a property and let's say they got a VA loan on that primary residence, and then later on they wanted to buy another property, a rental property, or another primary, they can go out and get another conventional loan. That would be no problem, conventional or FHA. If they have a VA loan now and they're going to move out of that property, and they're going to, let's say their family got bigger, they bought a small property with a VA loan, and now they got kids, they need a bigger house, they can still go out and buy another property using the VA entitlement again. So they could keep that existing house that they have, they could change it to a rental property, keep the VA loan, and then purchase a new property with another VA loan. It's something that underwriting looks at because they want to make sure, obviously, that people aren't trying to fake the system and say they're going to buy a primary residence and try to do zero down or this very low down payment. So it's something that they look at to make sure that it makes sense, right? Like from a smaller house to a bigger house where they relocated due to work, stuff like that.
Yes.
Okay.
So they would have a VA loan on their existing house. Now they want to purchase a new property. That VA loan would not leave. It would stay with the first property, but they would still have, like we talked about, partial entitlement. So they could still purchase the new property with a VA loan. Depending on what the entitlement amount is, depends on, again, how much they would have to put down. So maybe when they buy the new primary residence, they could do a VA loan, but they may need to put down a little bit of a down payment this time. But they would still get the no PMI, the low interest rate, and all that.
Very good.
What are some misconceptions about VA loans?
I mean, misconceptions are that it's hard to get your offer accepted, right? You guys might know as a listing agent, right? If you're receiving offers on a property and somebody is using a VA loan, a lot of times the listing agents, they're not, like you said, they're not familiar with it. They're thinking it's harder, like there's no money in there's no down payment. So if it appraises low, we're going to have a problem, that it takes a long time to go through processing and underwriting. So those are kind of the misconceptions. I mean, if they are putting zero down and the house that does appraise low, you could have a situation there, right? Just like any type of loan. we do need to get an appraisal on the property for VA. So if it did appraise low, the veteran can only finance up to what the appraised value is. So if it appraised 5,000 low, let's say, we could finance 100% of the appraised value, but they would, if they still wanted to go forward, they would need to bring in the difference to the sales price.
Have you personally experienced buyers that don't get their offers accepted?
Yeah, it depends on, I think, the property, the competition, how many offers there are. But a lot of times, what I would recommend is you submit that VA offer and let the lender know to call the listing agent. And that's where we kind of come in and go, hey, look, don't get scared by a VA offer right here. This is a fantastic buyer, fully underwritten and approved. We can close this. And again, it does not take a long time. It doesn't take 45 days. You can close a VA loan in
And that always does help when you call
17 days, 14 days, right? So yeah, I think just maybe letting them know that it's not a sketchy offer, you know what I mean? Like they're super solid. It's a great offer.
So it can close within the normal time frame.
We would want to make sure that they're super solid. We don't want to put a veteran into an offer that they're not sure if they can get approved for. We usually will collect all the documents up front, make sure underwriting looks at it, make sure that everything's super solid. So when they're placing their offer, it's 100% a success if the offer gets accepted. Yeah.
Can a VA purchase multifamily properties with a VA loan?
So a VA loan, you can purchase basically any residential property, 1-unit single family home, condominium, manufactured home, even multi-units up to 4 units, as long as they're going to be living in one of the units. If it is a condominium, the only difference is the condominium complex has to be VA approved. So it's something that we need to look for. And it's done on the lender side. So if they're looking at a particular property and it's a condo, what we'll do is we'll look up the HOA and make sure that it's a VA approved complex. So again, if they submit the offer, that they're not going to be surprised that there's a reason why they can't get the offer accepted on that property. But yeah, that's the only difference. Otherwise, they can purchase anywhere from 1 to 4 units.
So you have access to knowing whether it is VA approved?
Yes.
If
Yeah.
they
Yeah.
just give
There's
you
a
an
VA
address.
condo portal that you can type in the HOA and stuff like that and make sure it is approved.
Wow, that's good to know. What advice would you give to a veteran who might be thinking about or interested in buying a home maybe in the next 6 months to 12 months? How can they start getting prepared before they come meet with you?
Yeah, I would say you probably don't need to do a ton of preparation. The first step would be, again, making the phone call to a lender, have them take the application, kind of look at your situation. Usually we start with a soft credit check, so it won't hurt you at all. But yeah, just do the initial application so we can kind of look at it and see. And if the credit needs work, or if there is something there that they need to work on, at that point, we would give them like the instructions, like, hey, here's what you should do. Like, go down, pay these 2 credit cards down, wait till you've been on the job X amount of time, or whatever it is. So, we would want to look at it and just kind of give them some guidance. But if they're just thinking that they're a ways off and they want to be ready in a year or so, then they would want to do just like any other preparation to get a home loan, is just try to keep all your payments on time on your credit. Don't change jobs. Don't go from a W-2 job to all of a sudden a self-employed job. That can cause a problem if we can't verify tax returns for 2 years. Don't co-sign for somebody else, maybe, right?
So same as we've advised in other episodes, it's just do the application and get some guidance. If you're not ready now, the lender will prepare you.
Yeah, for sure. I think that's the best bet. Not to be worried and think like, hey, I shouldn't call for a year or two because of this reason. A lot of times people are on hold.
Yeah.
Well, I want to wait till I pay down this, student loan, or I want to wait, I'll call you in a year. And a lot can happen in a year. Prices can go through the roof. It's best just to take a look at it, because a lot of times, like I said, there's lots of wiggle room and gray areas, and a lot of times people are pre-qualified and they're ready now and they don't know that they are. You know what I mean? They think that they're 2 years away, and it's like, hey, let's just look at it real quick. Well, hey, good news. You're pre-approved now. You could go out and purchase now. So whether they want to or not, at least they would know that, they're ready.
Yeah, and even if they're not, it's never too soon to prepare, and
No,
you're not going to be committed to anything just by applying.
correct. No money.
And if they are self-employed, are they still eligible for a VA loan?
Yep. The documentation requirements are pretty similar to FHA conventional. If you're self-employed, we do need to verify income, and they usually require a 2-year average of the income off of your tax return. So that's why I was saying if they were W-2 and all of a sudden they switched maybe to the same type of work, but now they're self-employed or 1099, The problem is we have to see the tax returns for the last 2 years. And if they have not filed yet, then we don't have any income that we can use.
Okay.
But when we are looking at their income on a tax return, and then they are self-employed, it's a little bit different because it's not the gross sales or what the 1099 show. It's what was reported to the IRS after expenses and things like that. So it's the amount, the net is what we're going to use for qualifying.
How does an assumption of a VA loan work?
That's been pretty popular recently because interest rates are a little bit higher. So if someone has a property that they're selling and they have a VA loan on that property, then the buyer can come into that property and possibly assume that current loan. So let's say someone has a loan on a property for $500,000, it's a VA loan, and let's say they got it back in 2021 and their rate's 2%, right? Amazing. If they're going to sell that home, let's say for $700,000 and a buyer wants to buy that property, they could come in and potentially assume that loan for $500,000 at the 2% interest rate. Now, a couple things have to happen. They have to get with the seller has a mortgage company that handles that loan. So they have to go through that company to make sure. They have to go through the assumption process, which is kind of like a pre-qualification process. And they got to get the okay from that servicing company to transfer it over to the new buyer.
From what I understand, it's a lengthy process too, is it?
It can be. It could take a little bit of time. You're probably looking at 45, 60 days. And then the other hard part, though, is that VA loan is only for a certain amount. So if the property is up for sale for $700 and the VA loan's for $500, they could assume that $500, but there's going to be a gap there, right, of $200,000 that they're going to need to either bring in the cash or get a second mortgage or something like that.
That same bank finance that difference of $200,000?
They might, yeah. I mean, just depends on, I guess,
Or
who
they
that.
can go with another third-party lender.
Yeah.
Do you know? Okay.
Yeah, they could do it either way.
Does the buyer have to be VA?
No, that's
Wow.
a pretty huge factor too. Yeah, it does not have to be a veteran coming in. It could be a regular person that's not a veteran that now is assuming that VA loan. So
That's huge.
no, it's great.
Yeah.
It's amazing when that works because like I said, that buyer could assume this much lower interest rate, have a much lower payment, but it is kind of a case by case, and you have to go through the approval process and make sure that it's going to work.
What mistakes veterans make when applying for a VA loan?
I think it would just be any mistake would be something like you would have on a regular loan, which is,
Buy a car.
yeah, go buy a car, go buy furniture ahead of time, put stuff on credit, co-sign for a child or parent's car. Anything that could affect your credit, add debt to your monthly expenses is a problem. Like I said, changing jobs right in the middle of when they want to buy a property is usually not ideal. I mean, if they're changing jobs and it's in the same field of work and it's a salaried position, then usually that's not a big deal. But if it's a whole different type of work and they're going to hourly pay, things like that, like you definitely don't want to do that if you don't have to, because it could affect your qualification for the loan.
Brian, going back to their previous question about the VA loan assumption, because I think that's a huge one. How do consumers find out? The only way that I think that they can find out about these assumable VA loans is if their agent would have to state that in the listing, right? That the VA loan is assumable.
That's pretty much the only way that you're going to find out.
They're going to find out.
Yeah.
Okay.
I mean, there's no other way to search for that, really. It would be, yes, the seller or the listing agent's listing the property and they know that the seller has a VA loan. Then if they were smart, right, they would list that in the listing, because obviously that's very attractive if it's a property that somebody could assume that VA loan.
Yeah, huge incentive. So for all our VA homeowners listening out there, just make sure that you know that you can offer that incentive and get a lot of interest for their home.
Definitely help you sell your property. Yeah.
What happens when the VA passes away and it is a VA loan and they don't have a spouse? Does it get passed down to the next of kin, or what happens then?
And I think if they had a VA loan on the property and they pass away and one of the child inherits the property, they can usually just continue making payments on that same loan. They would need to contact the servicing company that handles the monthly payments and everything, and usually send them a copy of the death certificate and stuff like that. But they should not have to refinance or change the loan. They should be able to just keep making payments on that existing loan.
Is there anything we didn't ask that we didn't cover with the VA loans?
You know what? I think you guys did a fantastic job. Super thorough with the questions. I think all veterans should look into this program, whether they think they have entitlement or not. This is something that is a fantastic loan for all those reasons. Low to zero down payment, no PMI, no loan limits, no debt ratio, low FICO. So it has so many good things. I just think every veteran should look into this and see if it's something that they can use.
Absolutely.
I agree. I know you do, several different loan programs, but one of them that I did want to touch on is the NAFCash. Can you explain or share with us how that program works?
Yeah. So this is another exciting program, and it can be used in conjunction with VA. So this is for VA buyers as well. We have a program specific for New American Funding. We call it NAFCash, which is just the New American Funding abbreviated. It's specifically designed for people that need to get their offer accepted on a property. And let's say they're having a hard time getting their offer accepted because they're placing offers as a veteran with zero down. And let's say the seller is not accepting they're picking other offers because that doesn't look strong. So it's created for a buyer that needs like a little help. And usually the best way to get your offer accepted is all cash, right? So what we do is we pre-approve the client. And let's say we're doing a VA pre-approval for the client. We make sure that we know we can give them this VA loan. They can now decide which property they want to purchase. And when the offer is written, it can be written as an all cash offer, close in 10 days, no contingency. So the buyer can put a super strong offer on the property. Okay. So I'm talking about VA just because, like we talked about earlier, sometimes it's harder to get the offer accepted because it doesn't look like they have this large down payment like somebody else, right? Or we use it a lot for people that are contingent buyers. So if you're a buyer that's buying a new primary residence, but you have to sell a primary residence first, way to get your offer accepted is presenting a contingent offer. So you can go in with our all cash program, and basically you pick the property, you pick kind of the terms, and then when you submit the offer, New American Funding will be the buyer. We buy that property all cash. We use our own funds for the earnest money deposit, the closing costs. We purchase the property, get it off the market. And then what we do is we write a purchase contract where we're the seller and the buyers are the buyer on that contract. And we open up a second escrow. So the buyers can see they are the end result buyer of that property. So the idea behind the cash is help someone get their offer accepted so they're not a contingent buyer and they lose the property they want. Or again, if they're a VA buyer and they're putting zero down and they keep getting their offers overlooked, this is a way to get them in as a top buyer.
Most or some people understand this loan as the bridge loan as well. And they
Well,
were
there's
very
two.
popular. Oh, there's
Yeah,
two
you can.
different ones.
Yeah, there's two different things here. We have a bridge loan as well, but it basically replaces a bridge loan because if someone is contingent and they're selling a house and they need to buy a new house, a lot of times they don't have that money yet for their down payment, right? Because they're waiting for that house to sell. So what they could either do is take a bridge loan, which means they're going to pull money out of the house that they're selling and use that for the down payment on the new house, or they could use this cash program where we purchase the property first. How we do this is the client would pick the property that they want to put an offer on. They decide what price they want to offer. And when you guys write the offer, the contract will have New American Funding as the buyer instead of the actual buyers. So we will use our proof of funds. We will come in and hopefully get the offer accepted as all cash. So now that property's off the market, we are in escrow to buy that property. And then we write a purchase contract where we're the seller and the buyers are the buyer from us. Okay. So we open up a second escrow so they can see they are the end result buyer of that property.
Gotcha.
So what it allows us to do is now purchase that property. If they are a contingent buyer, once we close on the cash transaction, we let them move into the property so they can have two properties for a little while. They can move all their furniture, move everything back and forth so they can get themselves situated into the new house. While the other property is being listed for sale, they're living in the new house. And then once they sell their home, that's when they will come in with the money from the sale to do the down payment, pay the closing costs, and then we put the property back into their name. So it's pretty handy. It's super handy if they're contingent.
If they're
It
fighting
also
with
works
other
for
offers.
Yeah, exactly. It also works for VA buyers, conventional buyers, jumbo buyers, but we use it, most often for that contingent buyer, or even somebody that's a first-time buyer like VA that's putting very little down and they're having a hard time competing with their offers. They could use the cash program to purchase the property and then buy it right back off of us after.
Now, do they buy it right at the same price back from you?
There's a little bit of a
New
fee
American?
to this. Yeah.
Okay.
So let me explain like the costs involved. So when we do buy that property, we are going to be the buyer. So we pay all the closing costs on that property. When we end up selling that property back to the end buyers, we're now the seller, so we pay seller closing costs. They came up with a fee, it's called the convenience fee. So if the home was a $600,000 home that we purchased all cash, we're going to raise that price by 2% and sell it back to them for $612,000. So there is a fee that's attached basically, or the price of the home goes up. They don't have to come out of pocket with extra money, but there is a marked up price a little bit to the house.
I mean, it makes sense to me that 2% is what you were gonna probably overbid anyways, probably a lot
Right.
more if you were
Exactly.
financing and trying to win over that offer.
How long does the seller have to sell that property?
So once we close on the cash transaction, they can move into the new property and we want them to sell their existing home, hopefully within 60 days. That's kind of the timeline on the way that we've written it up, but they will do extensions. So we've had it go much longer than that. We do not want to own that property. This is really just a service to help them get the property. So we will do extensions as needed. Now, once we close on the cash transaction, the buyer basically becomes a renter from New American Funding. So they're living in the new house. And we are keeping track of a daily rental amount. And it does not have to be paid at the same time that they're selling their house, right? But we are keeping track of the number of days until they officially close and buy it back off of us. So let's
Okay.
just say the rental amount is $150 per day. The rental amount varies depending on the cash price of the home, but we use like 150 here. So let's say they moved into the new property, they have theirs listed for sale. Theirs sells, it takes 45 days. Once they sell their house, that's when they'll have their money to come in and close on the transaction with us. Okay. So at that point, they would bring the money from the sale that would be used for their down payment, pay their closing costs, and then they would get a rental invoice for the number of days that it took basically that they lived there until they bought it back from us. So
That makes sense.
if it was $150 a day and it took 45 days, they'd have a rental bill for $6,750.
Okay.
Did
So
you say this program also works for a buyer that doesn't have a property to sell?
yeah, this does not have to be for a contingent buyer. This could be first-time home buyer, for a conventional buyer, VA buyer, jumbo buyer, and even like non-QM, like self-employed bank statement programs. So it can be used for any of those situations. The ones we see it most used for, though, are like the contingent buyer, the VA buyer, or the first-time home buyer who's out there placing offers on a house, and let's say they just don't have a large down payment. So when they're placing their offers, it doesn't look as strong maybe as other people that are putting 10%, 20, 30% down. They're having a hard time getting their offer accepted. Then they can use the cash program and come in and, now they're the top buyer usually on the property because they're coming in as all cash with like no contingencies.
Is there a purchase price limit?
There's a purchase price limit for this, for the NAFCash program, and it's set at $2 million. So we're looking for properties that are 2 million or less. But again, we're not turning away anything. So if the property is above 2 million, we just have to look at it and see if we'll make an exception.
If I saw my dream home and that cash offer was going to help me win the offer, I would totally go for something like this.
Yes.
Yeah, it's a great program, and there are those two fees, but just like you said, like a lot of times that marked up percentage of the purchase price, if it's a popular property, you're going to be maybe in a, if you're going in with a financed offer, you might be in a bidding war, you might go over that price, right? So
Yeah, I mean, I just
if you
had
just know, right, I know I'd rather take my best foot forward and go in all cash, and I know this would be the final price.
yeah.
And sometimes you can get the house for less. Like I have two that closed last month, and one got the price. It was a $2.5 million home, so we did make an exception for the NAFCash, and then they were able to get the property for 2.35. So they got $150,000 less on the house because they went cash. So then when you add that, 2% markup, they were still way ahead. And the other one was another large one. I think it was like 1.75, but they got it for $75,000 less.
Wow.
So both of them super excited. They were able to get the property. They didn't have to sell their home first. They got the home for less. And it makes it pretty convenient because you're able to have two homes for a little while there. So you can paint the new house, carpet it or whatever, live in your old house. Once you're ready, you move all your stuff into your new house. You can get your existing house vacant, staged, That
Yeah.
obviously helps it sell faster for more.
Less
So,
stress.
yeah, exactly.
That's awesome. What type of client or do you see taking advantage of this program?
Yeah, the most popular is the contingent buyer. Another good thing is people that are moving out of state. So we do loans in all states. So I've done quite a few where people wanted to move to Nashville, Idaho. They need to sell a house here in California, and so they're confused on how to do it, right? Do I sell, then move to Nashville, but now I'm renting and I put my stuff in storage. I don't know where I'm going to live. Well, I mean, it's perfect. They can go to Nashville, find the house they want to buy, use the NAFCash to purchase that property. Now they've already got their property out of state where they're going to move. So then it's easy just to move everything from California to the new house and then sell that one. They're already living in the new state. So it works good for that too.
Are you the only ones that offer this cash
Yeah.
program?
Well, yeah, this one, ours is called
Here in our area.
NAFCash.
Okay.
It's the only program that works this way. There's another program that's similar, but it's the way that they work, it's different. But yeah, we're really the only company that offers this.
That's
Yeah, and
great.
I'm glad that you clarified the difference between this program and the bridge, because I thought they were the same. But the bridge is just them taking out their equity, buying a home with a bigger down payment. I'm sure you guys will also look out if the house is marketed correctly, priced right. You keep track of that, right?
Before we pre-approve them for this program, we ask you to send us a CMA and a net sheet for the house that they're going to sell. So we want to make sure, is this a realistic price? How much do they owe? Like how much, you know what I mean? How much are they going to make from the sale? So we can determine on our side, like how risky is it, right? Are they going to
Right.
make 100,000, but they need 100,000 exactly to buy the new house? Well, then that might be too risky, because what if they have to drop the price and now there's not enough money? So yeah, we're looking just to make sure that the sales price looks accurate. We see kind of what they're going to net, and then we can figure out how much they're pre-approved for on the other side.
And that homeowner has to have enough equity.
They
Make
do.
the risk
We usually
lower.
we usually require or want them to have 30% equity in the house that they're going to sell. And again, that buffer zone is usually like what I just said. We want to make sure there's enough money. If they got that property on the market and it's not selling and you have to drop the price a few times, we need to make sure they're still going to make enough no matter what to qualify for the new purchase.
They have the room.
But
okay.
it's too. There are exceptions to that, again, because let's say they don't have 30% equity in their house, but they're so well qualified on the income side and stuff that they don't even need to put down. Let's say they qualify with 5% down on the new house, then we just need to make sure there's enough room, right? We don't need to.
Okay.
They don't need 500,000 here if they only have to put down 20,000 here. You know.
Yeah.
Okay. And then interest rates is basically whatever the loan is approved for. So there's no changes there.
Nope.
Very
When
good.
they get the loan from us at the end, they're going to get whatever type of loan that they qualified for, whether it's conventional VA. They get a standard loan, standard interest rate, no marked up charges or anything there.
Okay. That's awesome. Is there anything else that you want to share about NAFCash?
Again, like I said, it works in all states. It's again, it's a nice niche program, and it's a great program actually for any time you're getting a buyer pre-approved. Like when I'm doing pre-approvals for a new client, whether they're a first-time home buyer or contingent, I usually look to see if they qualify for the NAFCash and get them approved for both options. So, let's say you have somebody and we pre-approve them and send you as the agent a conventional pre-approval letter with 5% down. We could say, great news, they're pre-approved for a conventional loan, 5% down at 800,000. And then we could also give you a NAFCash approval saying, also, they're approved at 800,000 all cash. And so for your buyer and for you, as you're out shopping at properties, they would have two options, right? So if they see a property that they love and they say, we, place the offer as a regular conventional offer, 5% down, they could try that. If there's a lot of competition, or if they feel like, I don't want to risk losing this house, you would always have the cash option where you could say, this one's going to get like 10 offers. Like, do you love this house? Do you not want to lose it? Like, let's go in as all cash,
Now you have more leverage.
Right. So both times, you have two options kind of for the clients.
That's great.
Very
That's
cool.
really plan B, having plan B ready to go.
Exactly.
Yeah.
Well, thank you, Ryan, for being with us on this episode. We appreciate you taking the time and explaining these two programs, and we'll definitely share them.
And how can people contact you?
Thank you guys, first of all, for having me on. That was fun. I'm in New American Funding, downtown Glendora. So you can find me on newamericanfunding.com. you would be able to look up Ryan Schultz, or it's nafhomes.com/Ryan Schultz, or on Instagram, it's schultzlendingteam.com. And I think those are probably the best ways to reach me.
Okay, great. And I will also share that contact in our show notes. Ryan, really appreciate your time. I know you're a busy man, and thank you so much for being with us today.
No problem, guys. All right. Thanks a lot.
Thanks for listening. Let's talk SoCal real estate.
If this episode helped you, be sure to subscribe, follow, and share it. And tune in for new episodes wherever you listen to podcasts.
And if you're thinking of buying or selling in Southern California,
click the link in the show notes for your free buyer's guide. And if you have any questions, email us. We'd love to answer them all on the upcoming episodes.
Isabel Machrone and Rosa Ortiz are licensed real estate agents with Keller Williams College Park. Each Keller Williams office is independently owned and operated.
The information shared in this podcast is for informational and entertainment purposes only and reflects our personal opinions and experiences. It should not be considered legal or financial advice.
We make no guarantees regarding accuracy, timelines, or results. We always recommend consulting with licensed professionals and doing your own research before making any real estate decisions.